types of accounts, in a way, elements of financial statements. We have learned that there are 5 elements of financial statements: assets, liabilities, owner's equity, incomes, and expenses. As a matter of fact, all these types of accounts are important to identify correctly debit and credit. These become bases to identify debit and credit. This base is in fact ultimately used to recognize that which accounting head would be debited and which accounting head would be credited. So we have to learn these elements of accounts and different types of these elements of accounts. But remember one little thing over here, that there are 2 approaches under which we classify these elements of accounts. So this module is about those 2 approaches which in fact classify financial information into different types of accounts. So there is a modern approach under which we classify financial information into 5 main heads. And those 5 main heads are assets, liabilities, equity, income, and expenses. Although we have already discussed these 5 main heads of accounts, but once again, I'm repeating that assets are economic resources of the entity, which in fact carry potential to be beneficial for the entity in future. Once again, remember this point that has already been emphasized, that assets are in control of the entity. These are the economic resources which are in control of the entity. If these are not in control of the entity, these can never be our assets. Then comes liabilities. These are obligations of the entity that the economic resources, which are assets, will flow out of the entity in order to meet these obligations. And equity is in fact the residual part of assets after meeting all liabilities. And this equity is in fact a claim of owners on the entity. Incomes are the earnings through which there would be ultimately an increase in equity, but such increase is not by virtue of capital contribution by the owners. Whereas this is the increase through which either the assets would be increasing or liabilities would be decreasing. But remember, this income causes an increase in the equity other than the increase by contributing capital in the business by the owner. And expenses are in fact outflow of benefits that has taken place because of decrease in assets or increase in liabilities, because of which the owner's equity is decreasing. But again, this decrease in owner's equity is not because of the withdrawal of resources by the owner from the entity. This is modern approach. But there was a conventional approach as well, through which financial information was classified into 3 heads of accounts. And those 3 heads of accounts are personal account, real account, and nominal account. Conventionally, these 3 types of financial information or accounts were used to identify debit accounting head and credit accounting head. Under this approach, for personal accounts, the receiver and the giver were bifurcated, that if a person is receiver or a person is giver, debit and credit rules were based on these 2 criteria. For real accounts, the criteria was what comes in and what goes out. And for nominal account, the criteria was that nominal accounts were segregated into expenses and incomes. This is just for the sake of a knowledge that we are discussing this conventional approach as a type of accounts. But what we would be following is the modern approach. So remember that modern approach is where we see 5 types of accounting heads: assets, liabilities, owner's equity, incomes, and expenses. Whereas conventional approach is where we find 3 types of accounts: personal account, real account, and nominal account. These 2 approaches are in fact used to identify or to analyze debit and credit, because in each transaction we will analyze 1 debit and 1 credit. We, in our course, will be following modern approach to analyze debit and credit. Thank you.